I was making
Right.
9% on private credit the entire time with less risk. And so private credit is because banks, you saw what happened in Silicon Valley, right? Banks are tightened up and they don't loan as much. So companies that are anywhere from 100 million to say 3 to 4 billion, there's 200,000 companies like that in the United States that are borrowing money all the time, and who they borrow from is private credit. But here's what's interesting. If you don't know private credit, I can give it to you in a metaphor. If you had a house right now and you got a mortgage rate at, say, 3% or 4%, whatever, back then, and it was fixed, you don't care that the interest rates went up. You're doing great. But if it's readjust, if it's a floating rate, you could be in trouble. Well, all these business loans are floating rate. So these private credit firms loan money at 5 and 6%. That's what business was borrowing at. And guess what? When the interest rates went up, they float with it. So now they're paying 11% plus. Well, it's the same loan, it's the same time period, but you just doubled or tripled, in some cases, your income stream when you own the private credit. Plus, I get the 2 and 20. So it's like,
Right.
these are, you don't have to get rid of your bonds. These are a complement to your bonds, but they're 2 to 3 times higher returns. There's the energy industry.